Thanks, Karen. Our final investment presentation today is from someone who's been making history from the Sohn stage for decades now. Can't wait to hear what he has for us today. Ladies and gentlemen, David Einhorn.
Thanks, Graham. I was hoping that this year the Sohn conference would be in person. I enjoy the energy in the room and the immediate feedback I get of the most interesting and what I think to be the funny parts, which I only know are funny when I hear you laughing. Here's the disclaimer. I'd like to remind everyone that the ideas I'm about to present are existing positions in our portfolio. We may change our positions at any time. This is my Grandpa Ben and me. This may look like a 1-year-old birthday party, but I have it on good family authority that this was actually my first gold talk. Grandpa Ben was a big gold bug. He believed that replacing the gold standard with fiat money would end with a terrible inflation. My question was, when would this happen? Grandpa Ben's answer was, eventually. After I began managing money, Grandpa Ben continued to prod me. Here we are at the American Economic Institute, which Grandpa Ben supported, where I went for another weekend of indoctrination about gold. And yet, we owned no gold. Eventually is not a good time horizon for a hedge fund. However, my thought today is that eventually is now, or at least it is soon enough that gold is a buy. It's no secret that the US has had a deteriorating fiscal situation for some time. Pete Peterson wrote a whole book about our demographic and fiscal situation in 1993. Back then, our long-term problems were visible, but long-term. The rubber would meet the road when the baby boomers retired. Politicians used to take this seriously. We made some progress along the way. The Graham-Rudman-Hollings Balanced Budget Act of 1985 set targets for deficit reduction and created sequestration orders to automatically reduce spending if targets weren't met. This led to a balanced budget in 1999. In 2002, Graham-Rudman expired. Since then, fiscal incontinence has been a bipartisan effort. Here we have Dick Cheney, whose boss added a large unfunded new drug benefit for seniors, and Donald Trump, who had the deficit explode during his term, arguing deficits don't matter. They supposedly represent the conservative party of fiscal responsibility. In response to the great financial crisis of 2008, we socialized a lot of the private sector losses and transferred the problem to the sovereign. The Democrats, believe it or not, have been somewhat better. President Obama entered with an astronomical deficit and left with merely a large one. Then COVID came, and any remaining fiscal discipline went out the proverbial window. First came the $2.2 trillion CARES Act in March of 2020. Given the crisis, this seemed completely understandable. In October 2020, Powell confidently asserted that when it came to Congress spending more, the risks of overdoing it seemed for now to be smaller. Implicitly, he promised to print whatever was needed to facilitate this. In a statement right after Mr. Powell's speech, Nancy Pelosi stood proud and said Chairman Powell's warning could not be more clear. Robust action is immediately needed. This led to an enormous second $900 billion rescue stimulus in December 2020. In May 2021, Janet Yellen said, and I'm paraphrasing, historically low interest rates mean the government can spend now. Debt concerns should not keep the government from spending. Even though the peak of the crisis had long since passed, we got the $1.9 trillion American Rescue Plan in March of 2021, and with unemployment nearly back to pre-COVID levels, the $1.2 trillion Infrastructure Investment and Jobs Act in November of 2021. Some people called our spending modern monetary theory. Others just called it helicopter money. In any case, the Treasury borrowed and the Fed supported the purchases. Some would call that money printing. In sum, the total of this is that the U.S. debt to GDP has exploded. When Paul Volcker raised interest rates to 19% in 1981, the U.S. debt to GDP was just 30%. Heading into the global financial crisis, it was about 60%. Twice. Today it is twice that. And much of this new national debt has been purchased by the Fed and sits on its balance sheet. The Fed currently owns over 19% of all outstanding Treasury securities. The $3.3 trillion increase in Treasuries on the Fed balance sheet fully funded the entire deficit and then some. Generally, the deficit tracks the economy. When we have full employment, deficits usually are around zero, as taxes are high and social safety net benefits are low. Despite the top of the cycle conditions today, which historically created a balanced budget or even a surplus, we still have a projected deficit of over 4% of GDP this year. Meanwhile, the US demographic situation is getting more precarious by the day, literally. Every day in the US, 10,000 people turn 65, and the Social Security trust funds are projected to be used up in just 12 years. Already, the trust funds have become sellers of treasuries. The Congressional Budget Office projects a 2022 deficit of over $1 trillion. Demographics will cause this to more than double in a decade, and these projections don't assume a recession, rapidly rising inflation index benefits such as Social Security, or high interest rates on the national debt. As everyone knows, we have an inflation problem. I don't have time to discuss all the reasons. It isn't entirely the fault of fiscal and monetary policies. However, those policies are inflationary and have facilitated an environment where inflation could take off. The ESG movement has thwarted investment in traditional sources of energy, combined with investor eagerness to throw nearly all growth capital at software is eating the world companies, has driven up the cost of equity for companies that ensure the world can, in fact, eat. The current energy crisis isn't causing any change. Rather than stimulate supply, the US is threatening windfall profit taxes on producers. And the G7 countries and Japan just pledged to stop most fossil fuel financing by the end of 2022. Our supply problems aren't limited to a short-term inability to get goods from China, but extend to a decade of structural underinvestment in capacity in the so-called old economy. For years, there was no real interest in investing in cement, steel, concrete, fertilizer, chemicals, paper, mining, traditional energy, and housing. Higher prices aren't fueling new capacity. Instead, they're fueling buybacks, as investors and managements don't want to underwrite permanently higher prices or margins. Very low PE multiples in these affected industries don't inspire long-term capital commitments. Normally, high prices generate a supply reaction. Since this isn't happening, all the work to curtail inflation will have to come from the demand side. As a result, prices will have to go much higher to dissuade substantial consumption. As such, inflation is likely to be much more persistent. As a side note, and gratuitous reference to our portfolio, this lack of new supply means that companies in these industries are likely to earn excess profits for an extended period of time, making these sectors attractive long investments. However, the inflation was completely predictable. As Greenlight wrote over 2 years ago in our quarterly letter of May 1st, 2020, after COVID started, in a broader sense, we believe the economic shock will turn out to be inflationary. People and businesses who aren't working are no longer supplying goods and services. The social response of replacing most or all of the lost income sustains demand, or if temporarily hoarded as savings, creates pent-up demand. Although both supply and demand are falling, supply is falling more. The inflation is unlikely to appear immediately. Opportunistic price gouging on toilet paper, hand sanitizer, milk, rice, and potatoes is not a signal of broad inflation. However, a country that consumes much more than it produces, financed by ongoing money creation, will have much more money chasing fewer goods and services. Once the initial shock wears off and the recovery begins, the inflation will begin to show up. And the US is not alone. It's a global pandemic and a global response. We expect inflation on a global basis. And it has. Current official inflation is now 8.5%, the highest since December 1981. Everywhere you look, prices are going up, and the worst part is that despite how shocking it is, the surge of inflation is actually understated. Everyone understands that inflation is even worse than the official reports. Since 1980, the Bureau of Labor Statistics has changed the way it calculates inflation. They've added hedonic adjustments for quality improvements, quirky substitution changes, and importantly, suppressing rising home prices from the calculation. Larry Summers just published a paper showing that had the methodology not changed, just on housing, inflation today would rival the peak from 1980. As we watch the Fed implement unconventional monetary policy, the Fed promised it could handle inflation when and if it occurred. For example, here was Ben Bernanke promising he could raise interest rates in 15 minutes if needed. As it turns out, this wasn't quite right. In order to raise rates, the Fed had to first get past its view as of June 2020 that we're not even thinking about raising rates. A year later, with inflation already reaching 5.3%, the Fed began talking about when to raise rates and indicated it expected to do so beginning in 2023. In November, with inflation at 6.8%, the Fed acknowledged an inflation problem and retired the word transitory in discussing it. And once they realized there was a problem, the Fed couldn't react in 15 minutes or aggressively at all. Even with an acknowledged inflation problem, Powell continued to hold rates at zero and print more money. It took the Fed an additional 5 months of tapering QE before interest rates could be raised. Finally, in March of 2022, with inflation at 8.5%, the Fed raised interest rates by 25 basis points. We're now on a path to raise rates 0.5% at a time until rates reach an arbitrarily determined neutral level of around 2.5 to 3.5%. This gentle response is akin to trying to clear your snow-covered driveway with an ice cream scooper. With inflation running at about 8%, it's hard for us to understand why an interest rate of around 3% would be neutral. If the Fed were to continue using the balanced approach rule that it regularly cited under Chair Yellen, a neutral rate today would be about 7%. It is monetary policy 101 that to defeat inflation, you need positive real interest rates. In 1980, Volcker raised rates to 19% to combat 14% inflation. Greenspan raised rates in 1990 to 8.5% to fight 6% inflation. Even Burns raised federal funds to 13% in 1974 to fight 11.5% inflation, but retreated too quickly to get the job done. Today, we have real interest rates at the most negative level in the last 70 years. The idea that tightening 1% or 2% from here will beat inflation is hardly credible. The Fed claims it has powerful tools to fight inflation. At this stage, those consist of raising rates and running down the balance sheet. However, the Fed is limited in raising rates. Powell faces a problem that Volcker didn't have. We have $24 trillion of debt held by the public, which is up over 6 times in the last 20 years. Approximately $7 trillion has to be rolled in the next year. Every 1% increase in the rates adds $70 billion to the deficit. So raising rates to 4% would add $280 billion, 8% would be $560 billion, and a full Volcker, 19%, would be $1.3 trillion. And that's just the first year. Raising short-term rates will also cause a strain on the Fed's financials, where assets are of long duration and the funding is at overnight rates. $5 trillion of overnight liabilities cost an extra $50 billion per percent increase in the interest rate that the Fed will pay on reserves. I'll let you figure out the rest of the math for bigger increases. The fiscal situation has limited the Fed's flexibility. And that doesn't even take into account the impact of a slowdown that is likely to follow peak employment. An average recession could easily add another $700 billion to $1.4 trillion to the deficit. So while the Fed can raise rates, it isn't clear it can raise them enough to get the job done. As for running off the balance sheet, this may also be limited. Last year, the Fed essentially bought all the excess supply offered by the Treasury. This year, the Treasury will borrow, and the Fed plans to run off its balance sheet, adding more supply. But now there's another factor to consider. If it wasn't clear prior to February 24th that a new world order is imminent, it's blindingly clear now with Russia's invasion of Ukraine. For decades, countries feared a day when the US would weaponize the dollar, and that day has come. In order for an asset to be a reserve asset, it has to be a safe asset, which means that it has to be available when you need it. When we consider freezing Russian central bank reserves as sanctions, Russia sees it as our default. The Chinese press has noticed and warns the backlash has consequences, and these actions will be clear for all to see over a period of time. Suddenly, in the wake of Russia's reserves being frozen, China, India, and Saudi Arabia could perceive that those hundreds of billions of dollars of reserves could be condemned to a similar fate. The Chinese are wondering what to do with their $1.1 trillion of U.S. government debt. Yu Yongding is a widely recognized influential Chinese economist who served on the Monetary Policy Committee of the People's Bank of China. I would not expect foreign countries to announce that they are selling their U.S. debt. It's not like they can go to JP Morgan and get a bid on $1 trillion or so. In other words, the current deficit, combined with the Fed's quantitative tightening plans, combined with the possible selling and runoff of U.S. treasuries by foreign central banks, who are worried their reserves could be frozen, could create a supply-demand imbalance in the Treasury market. This would lead to much higher rates and frustrate the Fed's ability to run off its balance sheet. Putin thought the US might act against him and began selling Russian treasuries after it illegally annexed Crimea in 2014. Since then, Russia's gold holdings have tripled to 22% of total reserves. When countries don't trust each other over bonds and currencies, gold becomes the ultimate reserve asset. And I say gold rather than crypto because gold is already recognized as a globally acceptable central bank reserve asset. Gold as a percentage of total reserves remains staggeringly low. India is at 8%, Saudi Arabia and China are at 4%. The question is whether there's enough gold to back the currency reserves. The answer is for the price of gold to go higher, perhaps much higher. When Powell was asked if he would do whatever it takes to fight inflation, he deflected by saying, "I hope that history will record that the answer to your question is yes." I interpret this to mean that he will do whatever he can and hopes that it will be enough. Powell says he has powerful tools to fight inflation and the resolve to slow down the economy. This contrasts with Andrew Bailey at the Bank of England, who admits the central bank feels helpless. Larry Fink says he doesn't believe the Fed has the tools. So let me conclude with this. The Fed is bluffing. Powell says he has strong tools, but the world has changed. From 1980 to 2020, we had structural deflation. Now we have structural inflation. In a deflationary environment, the Fed raising rates causes a slowdown. Here, inflation is the cause of the slowdown. The Fed raising rates might perversely increase the inflation by having a bigger impact in thwarting supply than on demand. Meanwhile, higher rates mean more interest income for savers, which could trigger even more demand. And of course, this responsibility is being placed squarely on the Fed. Policymakers are not even discussing fiscal austerity to combat inflation. To me, this means inflation ain't going away so fast. The Fed doesn't really have the tools to stop the inflation. That doesn't mean it can't do anything. It will do what it can. And maybe it will work. We probably won't know this year. This year, they can raise rates a few times and run down the balance sheet a bit. But next year, the rubber will likely meet the road. As rates cross 3 or maybe 4%, either the inflation will come down or the Fed will have to recognize it's out of bullets and capitulate to the inflation. It simply can't do much more because it must undoubtedly ensure that the Treasury can fund itself. When the Fed has to choose between fighting the inflation and supporting the Treasury, I think it has to pick the Treasury. Some are criticizing the Fed for tightening into a downturn. Just wait until they're forced to loosen into an inflationary spike to support the Treasury. At that point, it's best to have some gold. That's what Grandpa Ben taught me. Thanks for having me at this year's Sohn conference. I said last year I expected we could do it live this year. I hope that 2023 is that year. Thanks so much.